the Fed is raising rates. We better go refinance our mortgage. We better go lock it in. The Fed is raising rates. Let's take a look at what the 30-year bond was 3 years ago. Yes, 3 years ago today. Interesting, is it not? 2.92% on December 21st, the solstice day, whatever it is, 2015. 2.92% was a 30-year Treasury bond. What are rates today? After 9 times the Fed has raised rates. Let's take a look at our trusty Treasury website, which is treasury.gov. Daily, it was treasury.gov. It's the Daily Treasury Yield Curve rates. You ready, my friends? I'm going to look at this right now. 2018, December 20th. So 2018, December 20th, that was yesterday, so we don't have today's rates. Let's take a look. You ready? You ready? Now remember, the Fed has raised 3 times. 3.02. The Fed doesn't control long-term interest rates. They don't, my friends. The Fed controls short-term interest rates. And let's just look. We'll look at 6 months. So right now, the 6 month is 2.55. What was it in 2015? I'm willing to predict is much lower than that. The 6 month in 2015 on December 21st was 0.64. So that's gone up 200 basis points about. Whereas the 10-year, 30-year Treasury has gone up from 2.92 to 3.02. But the Fed has raised 9 times, count them, my friends, 9 different times over the last 3 years. The era of easy money is over, and yet, look at that. 10-year Treasury, and this was at just 3% just 2 days ago. In fact, if you want to be even that much more banal, if that's the right word, let's take what it was. And I don't even know what's going to be today when the markets are getting hammered again today. It was at, let's see, 2.97 back in June. All right, so you can see not much of that's June of 2018. So not much of an increase at all when the Fed's raised on the long-term bonds at all, long-term treasuries. When the Fed is raising, 2 things you need to be considering. Don't fight the Fed. We know what happens when the Fed raises. In 1994 and 1999, this thing both happened. The Fed was raising rapidly like they've done over the last 3 years. Stock market on the front end gets hammered. In 1994, 1999, the bond market got hammered in particular. And the same thing will happen this year for sure. But don't fight the Fed means when the Fed's raising, a lot of times people are going to sell stocks in order to buy bonds. It cycles itself out. That's what happens. But in the short term, typically stocks get hammered. The bonds, we don't really know, but in 94 and 99, the bond market got hammered a little bit. We're not talking significant. Well, I guess for bonds it could be. And the same thing will happen this year as well. But at the end of the day, why is the rates not going up in the long terms? Because that's not what the Fed controls. They control the short terms. They control the short-term certificate of deposit rates because everything's kind of based on the Fed funds rate. They'll control the banking account rates or savings account rates or checking account rates, short-term loans. I don't know so much on credit card debt. I think that's more supply and demand. And right now the banks, I mean, the banks got so much liquidity. If they need to lower rates on credit cards to get you to be a consumer, they can easily do that. The banks operate in what's called net interest income. That's the #1 way they make money. Net interest income, at least on not commercial, but regular consumer banks. NII. If you look at a P&L, a profit and loss statement, you're going to see 2 things that drive their branch, that specific branch, the branch you know where you go see Jane the teller. That branch has a P&L, a profit and loss statement, and that's based on 2 different things, net interest income, and the second one, believe it or not, is overdraft. Believe it or not, bouncing check fees. It's a pet peeve of mine. But anyway, net interest income, how much they're paying out to to lenders. People are lending money. Depositors is a better way to look at it. How much are they paying to depositors and how much they getting back from lenders. All right, so their liabilities are on a deposit. They owe money to the people who deposit that. That's a bank's liability. For you as an asset, for a bank is a liability because they are on the hook to pay that money back. Their asset from a bank is how much they're lending out. So if a bank can say, look, we'll give you 1% to bring in a CD. We're going to turn around and lend that at 5%. That's the net interest income, essentially, for a bank, for its P&L statement. Now, if they can get away with 7%, they're going to do that. They'll say, we'll give you 1% on the CD, but we're going to lend it out at 7%. They'll do that. But then you can have another bank that's very capitalistic, very competitive, is going to sweep under there and say, screw that, we'll give you 6%. Because banks are competing for your business. That's all there is to it. The banks want your, I'm telling you right now, having been a commercial banker, small business banker, I'd look to take other banks' loans all the time. What are you paying? What's the rate? What kind of fees you're paying? What can we increase your line of credit? We got paid on the line of credit amounts or the banks, the loans, what's called our portfolio. We got paid on the portfolio we managed. And we want to expand that portfolio, i.e. increase the amount of debt that you owed because that would increase our NII, net interest income. So if I could find you with a First Citizens Bank and I'm with First Union Bank, for instance, or vice versa, and I know that you're paying 7% with a $100 annual operating fee for your line of credit, now I can swoop out underneath that 6.5. I'm doing that and get rid of the fee because I'd rather have 6.5 than have nothing. That has nothing to do with this right here, the Fed funds rate. This has to do with my supply. Do I have enough cash in which to give you the loan? And if I do, I can raise that by giving a 1.5% one-time bonus to depositors to give me money for CDs so I can loan out. I'm doing that. Has nothing to do with this right here. The only thing the Fed funds rate will determine will be, again, typically the savings and checking accounts. Again, maybe your credit cards, not so much, but certainly the short-term side of the debt curve. The long term, it doesn't matter. The long term is all supply and demand. What the bank can get for what they can loan out. And this, as you can just see, I mean, 10 basis points, and that can change overnight. I don't even know what it's doing today. So just keep that in the back of your mind. The Fed does not control the long-term rates. Supply and demand controls long-term rates. And when the Fed's raising on the short term, has nothing, no indication at all if you should go refinance your long-term adjustable rate mortgage, or if you should go refinance your mortgage loan, because you hear it, and I guarantee you're going to hear it all the time. Refinance now while the rates are still low. The rates are going up. Refinance. They do. It's a sales tactic. It's a sales tactic. They're saying if you don't act today, you could miss out. The FOMO, fear of missing out. That's what they're concerned with. They're like, you don't want to be FOMO, fear of missing out. So go ahead and lock in your new rate today. And by the way, it's going to cost you $10,000. I mean, that's what they're trying to do. And then 6 months, a year, 2 years later, hey, Mrs. Smith, good job. You locked in your rate, but we have a discount on refinancing. Like, okay, that's great. Going to cost another $10,000. We're going to extend your term for another 30 years. That's what, just be careful. So I hope this helps. Just remember, long-term rates not dictated by what the Fed does. The Fed does short-term rates. Keep that in the back of your mind before you rush out and say, they're raising. I better go refinance my mortgage. Just be careful. We'll see you next time. Thanks, guys.